We look on, very good track to the recovery that we talked about. We said you're going to have some impact in first quarter and more impact in second quarter revenue. But in general, we're working closely with customers, and I think we'll continue to do pretty well versus the forecast we've given from a recovery perspective. The supply chains, I think, are things that are still going to take another 30 to 60 days for a lot of companies that are sourcing product from Japan for them to figure out what the implications are. So I think it could still be choppy from that perspective.
And could you talk a little bit about the longer-term positioning of TI, getting out of some of the commodity-related areas and focusing more on analog chips, and why that analog market is so attractive?
Yeah, it's one of these things that we've backed up, we've looked at the world, and if you take a look inside of any piece of electronic product that you would buy, and that could be a tablet, that could be a smartphone, electronics in your automobiles, there's an analog integrated circuit or an analog chip inside of all those products. And so we are the largest supplier to that market today, but our market share is still pretty modest at about 14%. So we just see an opportunity to have very broad growth and very long-term growth from that sector. So we have heavied up the resources of the company on analog and an additional sector called embedded processing. And while we've done that, we've allowed some things that look like they're going to become commodities longer term to get smaller, and we're working through that.
What's the hot product, Mr. Templeton? I know, Bill and I were talking about he's got an iPad, he brought it with him, uses it on the road, and obviously you're dealing with all these different options, with tablets being supposedly the next big thing. You've got the Playbook coming up from BlackBerry, which I know you're a part of. You've got the Apple system, you've got the Droid system. Which one, in your view, is going to be the winner?
Yeah, Aaron, I think in some ways you guys are covering it. There's going to be a lot of different products, be it a smartphone, be it a tablet, and our goal is to make sure we're in as many of those as possible. Where I get equally excited, though, is there's a lot of products that don't get talked about on a broadcast like CNBC. So making cars safer, backup camera prevention, cameras that are going in, a lot of electronics going into cars, electronics going into homes to be able to make power usage lower or power efficiency higher. So that's when we start to get pretty excited, is it's not just one area, be it great things like tablets or smartphones, but a lot of different pieces of end equipment.
Rich, you guys have been, in my view anyway, a leader in capital allocation among, not just among technology companies, among companies in general. You've taken shares outstanding down by 500 million since 2004. You've grown the dividend around 30% a year. Can you talk a little bit about how you think about capital allocation, and especially the issue of the so-called trapped cash and repatriation? Because if I'm not mistaken, I think you guys actually pay the tax, repatriate the dollars. So when I see the several billion on your balance sheet, it's actually available for shareholders as opposed to sitting outside the country. Is that right?
Yeah, no, that's true. I break it down pretty simply. First off, you have to have a business model that's capable of generating a lot of cash. The focus, Bill, as you know, on analog and embedded processing, I think has the ability to do that, both in terms of revenue and margins, but the capital demands are a lot lower from a manufacturing perspective. Second thing, when we think about use of capital or use of cash, number one is how are you going to grow better, grow well? So that's R&D investment, that's capital equipment investment for manufacturing, or acquisition money that could be spent. After that, it's a balance of dividends and buybacks. And yes, as you noted, you've watched us, you know my sentiment on that. We have been a full up payer of taxes on that, getting that cash repatriated, which lets us put it to work. And I think that's the right way to do it.
Mr. Templeton, it's interesting because obviously a lot of your competitors don't do that. I just wanted to throw one question at you. I was looking through your business and your 4 different categories. Other was really big, and it was bigger than I expected. Other's usually kind of the, I don't know, a little small leftover thing for a company, but not for you. And I saw calculators were in it. We had a lot of fun with that this morning. No one even believed people use calculators anymore. And I found them all over. Best Buy, Radio Shack, TI calculators. You still make them?
Absolutely. We have got a great calculator business. It's really focused at the education or math and science training side. It's about 5% of our revenues, but it is an exciting business in terms of, we're still very passionate about education at this company, and it's a great way to connect with a lot of young students coming up.
All right. Well, Mr. Templeton, thanks so much. We appreciate your taking the time.
Well, Aaron and Bill, thank you.
I don't appreciate the memories of calculus, but anyway, the old TI-83. Quick takeaway, TI, you're a buyer. I mean, you're obviously a shareholder, but you...
We've been a shareholder for some time. I think the key there is very high returns on capital, steady business, low market share that they can grow significantly. You don't have to worry about what's going to happen with the capital with this company. You've seen the valuation actually start to expand. So TI is, even though it's inexpensive, around 12 plus times this and 11 times next, it's now to a premium to companies like Microsoft, Intel, Cisco, and I think part of that is the capital allocation that they've done.
That you know the money's real. You don't know it's in some other country and coming back.
Exactly.
Well, Bill's going to talk a lot more about some of his tech plays and tech ideas as our special edition of Street Signs. Bill Miller decided to book investors today who've been around a long time to get their views on navigating some of the most volatile and frankly frightening markets in decades. Joining us now is Leon Cooperman. After 25 years at Goldman Sachs, he went into the hedge fund world. The chairman of Omega Advisors now has 45 years of investment experience and manages $6 billion. That's the kind of street cred you have to get on the show today. Lee, thank you so much. Good to have you with us. Bill was talking about how he is bullish on stocks, and I know you look at it as I can pick stocks, I could pick bonds, you have a lot of different choices. What's the best investment right now in your view?
Well, the way I look at it, frankly, is my investors come to me not because I'm a brain surgeon or I'm an expert in real estate or oil and gas. They come to me because I know something about financial assets. And the way I look at it, my choices are cash, which earns 0. No one knows the outlook for sure, so you have to have a little bit of that in case of things going wrong. Secondly, I could buy U.S. government bonds. They're yielding currently 3.3%. In my humble opinion, they're a short. I don't have that trade on presently, but in my view, interest rates 2-3 years from now will be materially higher than they are now. Third, I can buy high yield bonds. I'll give you a statistic. In November of 2008, the high yield index, Bloomberg high yield index, was 25%, and the S&P was trading at a touch under 14 times earnings. The high yield index presently is 7.8%, down from 25%, and the multiple on the market is slightly lower now than it was in 2008 when the high yield index was materially higher. So I don't look at credit as being particularly attractive now, maybe on a one-off basis. And so what I'm left with is equities, and the average stock is trading at a little under 14 times earnings, yields 2%, growing 7% a year, and I'm paid by my investors to find things better than average, and I think that the stocks are the best house in a good neighborhood if the economic outlook materializes favorably long term, and I think stocks are the best house in a bad neighborhood if things deteriorate. The best way to play the market, in my opinion, play financial assets.
Lee, what are you thinking about non-U.S. stocks, about the dollar, things like that? How's that play into your outlook?
I think dollar is heading softly lower from here. I think the U.S. economic outlook is better than Europe. I think it's regrettably, given the tragedy in Japan, better than what's going on in the Asian economy. So I think the U.S. is very well positioned. And so I would expect the U.S. market to be amongst the leading markets this year.
Bill, I wanted to ask you a question on that. We had the Egypt market open today after 2 months being closed. You know, that was a pretty developed market. A lot of retail investors would look at this and say, gosh, should I just avoid emerging markets, given all the volatility, given that they can just close down for 2 months? Does that change your view on emerging markets at all?
Not really. Emerging markets, I think, because they've done so well. I mean, the best time to buy emerging markets was after the collapse in the late 1990s. That's when you got the spectacular home run returns. And the worst time to buy emerging markets was, well, a year and a half or 2 years ago, after they'd done well. Everybody loved China, they loved India, they loved Russia.
Yeah.
And they liked some of the frontier markets like Egypt and all because, they'd done spectacularly well. Those markets have varying degrees of risks. I think you have to be aware of those. Some of those frontier markets, I think, are quite attractive long term, but they come with high volatility. And in this case, I think you have to make volatility your friend, not your enemy. So when things go awry there, I think that's when you want to increase your allocations. When things are going great, you made a lot of money, take a little bit off the table.
Any frontier markets you can mention?
We're not in any of those things right now,
yeah,
but I will say, you know, we did some of that stuff back in the late 1980s of all things, and
yeah.
we went to Thailand, and then then we had the crash in 1987, and they shut the Thai market, which kind of acquainted us a little bit of risk in some of those markets, and then we thought, okay, but they'll open the market in a few days. They did open it, but only for Thai citizens to transact in. So the Thai citizens came in, they knocked the market down, then they let the so-called Farangs come in. So there is risk in those markets.
I guess these things come back in cycles. Lee, when I teased you coming into this commercial, I said you were going to talk about your number, and I heard you were saying, what's the number? What's the number? Okay, here's a hint, Lee, of the number you told me. It has to do with Brent crude.
Yeah, well, if I could lead into it, Aaron, late last year when we wrote our letter to our investors, Steve Einhorn, our vice chairman of Omega, and I worked very closely together. We said that to have a bullish outlook on 2011, you had to have a bullish outlook on 3 issues. First issue was the U.S. was not another Japan. This is before the earthquake, that we would have economic growth and the economic recovery would ultimately become self-sustaining. That was our view then. It's our view now. Secondly, we had to have a belief that the ECB would do for European financial institutions what our central bank did for U.S. financial institutions, and that we felt was a very good bet. And you're seeing that with the market's acceptance of Portugal's problems and the problems of Ireland. The third view you had to have was the president would soften his anti-wealth, anti-business stance and basically move to the center, and he got that message after the midterm election, and we felt very comfortable. I think given what's going on in the Middle East, you have to make a fourth assumption, which I frankly feel a little bit less qualified to make, but I'm making it, and that is what's going on in the Middle East is all about democracy and nothing sinister. And if it's about democracy, that's long-term bullish. If it's something else, then it's a different story. And so the way we're dealing with that is saying if the economy can handle Brent crude up to about 125. Much above 125, you're going to see an effect on the economy that will be adverse. And most of the oil shocks in the past have led to recessions, so we have to watch that very carefully. But so the fourth assumption, if the price stays below 125, we think we're in a self-sustaining economic expansion. We've lost sight of the fact, but the average economic expansion, once it gets going, lasts about 5 years. So we're relatively early into this new economic expansion. Valuations are quite reasonable. I mean, historically, the market's averaged 15 times earnings. It's less than 14. When the market was selling at 15 times earnings historically, the inflation rate was north of 3%. It's now somewhere around 1 to 2%. And the level of 10-year interest rates was 6%. They're currently 3.3. So the stock market is cheap relative to inflation. It's cheap relative to its own history. And it's cheap relative to interest rates. And I think the people are still very conservatively postured because of the transformative effect of 2008. Most people got really killed in 2008, and I was hurt myself, and so that led to very conservative behavior. Yep. I think also the flash crash of May makes people very wary. The individual is less involved in the market, so you have a bunch of hedge funds trying to game the market, and this is leading to a lot of intraday volatility, and I think people are less invested vis-a-vis equities than they've been historically. Pension plans used to be 65% equities, they're 50. Individuals were 25% equities, they're now 20. Yep. And so I think that generally what hits you in the neck is not what got you in the last cycle, something new. So my guess is the corporate sector is reasonably well positioned. I think the individual is conservatively postured. The next problem is probably in government finances. Okay. And my guess is it's a few years down the road.